Good morning, everyone. Thank you for coming back after the break. My name's Han Yik. I'm head of institutional investors at the World Economic Forum, and our topic today is the future of long-term investment management. I'd like to introduce our distinguished panelists today. Zubaid Ahmed, the vice chairman of Citi's Institutional Clients Group and co-head of the Global Asset Managers Group. To his left, Dr. Soon-Young Chang, senior advisor to the Investment Corporation of Dubai. To his left, Eric Knudsen, Managing Director and co-head of the Neuberger Berman Quantitative and Multi-Asset Class Investment Team and Multi-Asset Class Chief Investment Officer. And at the very end, Ms. Stella Ojekwe Oyejeli, Chief Risk Officer and Executive Director of the Nigeria Sovereign Investment Authority. The topic today, the future of long-term investment management, it's a very broad topic, and we've heard from the previous panel this morning in terms of the capital market outlook. So the question is, as practitioners, as asset managers and asset owners, what do we do about it? What is the future of long-term asset management? There's been a lot of talk this morning in terms of the new normal of low returns. I feel myself that the phrase new normal is overused, but we are in an unprecedented area where rates may not be what we expect from all asset classes, and that includes even alternative asset classes where we've seen traditionally stronger returns from. We've seen the fourth industrial revolution transform industries through digital transformation and disruption. And the question is, how are long-term investors reacting to all of this? So without further ado, I'm going to turn over to the panelists. And Dr. Chang, just want to ask from the perspective as one of the large long-term asset owners, one of the LPs in the room, what new trends are you seeing in terms of in reaction to all of this?
Yeah. I see there are three very remarkable trends in long-term investment management. That trend reflect investors' effort to cope with this challenging environment. The first notable trend is higher engagement with the investee companies. Here, higher engagement include holding direct communication with the top management of investee companies regarding the strategy, such as environmental, social, governance strategies. And the other form of engagement include collaboration with other investors to preserve their interest in the company, like exercising voting night together in favor of shareholders. And the third form of engagement is a kind of soliciting shareholder proposal to improve the company. So more like a becoming activist approach now, long-term investors. That's the first very remarkable trend. Second notable trend is proactive deal sourcing. Traditionally, long-term investors tend to be passive in sourcing the deal. But nowadays, including us, we are sourcing the deal directly in a very proactive way. For proactive deal sourcing, we fully utilize our own network, such as investee companies, GP, other investors. So this trend is now becoming accelerated now. And the third remarkable trend is integration of value chain. Now, more and more investors are involved in entire value chain. Especially this is very evident in real estate investment. Traditionally, real estate investors have limited their involvement in only financial aspect of investing, and very passively played a very passive role in other value chains such as asset management, development. But now, investors are begin to involve in this entire value chain, from development to investing to asset management. So I presume this trend will be accelerated and will be a key shaper of a future of long-term investment management.
Great, thank you. I think following up on that, I think that's an excellent summary of some of the trends that are prevalent right now. Eric, as one of the asset managers on the panel, I'd like you to explore a little bit more about this idea that Dr. Chang touched upon in terms of changing role of relationships between asset owners and asset managers.
Yeah, as an asset manager, listening to an asset owner, and I agree with those three trends, but what they say, first and foremost, is lower fees, and then lower fees, and then lower fees. And that's, I think, one of the main kind of changes and one of the key themes when you think about what's changed over the last 25 or 30 years in the industry and what will change dramatically over the next 25 or 30 years. So I want to focus on one particular trend that I think has many, many implications, and that is the changing relationship and really the changing relative power of asset owners relative to asset managers, asset servicers, investment consultants, banks, et cetera. I have been in the business for 30 years. I started in the business in the mid-'80s, and early in the life of institutional asset management, the asset owners were at the kind of the bottom of the food chain, low person on the totem pole. And they were really price takers, they were product takers, they were service takers, and the expertise lived at asset managers, investment banks, and asset servicers. And that has changed dramatically. Now, beginning in about the mid-1990s, there was a lot of discussion that this should change, that fees should come down, that asset owners should start doing more direct investing, more investing themselves. But I think what really catalyzed the change is this new environment, the low return, higher expected volatility environment post the great financial crisis and the associated regulatory changes in the environment. And that has created both and of course the increased scale of many of the largest asset owners. And that has created the impetus for asset owners to have to change the rules. In a low expected return environment, you have no choice but to say, I can't rely on the traditional sources of investment returns, the traditional risk premium, the traditional beta to achieve my investment objectives. I have to look at how I can get an edge. What unique attributes of my organization give me an advantage that can allow me to achieve my returns even if I can't rely on what got me my returns for the last 20 or 30 years. And as an asset owner, as the chief investment officer of our multi-asset class team, part of my responsibilities is to interface with our largest strategic partners, where we are engaging with them on discussions of, okay, let's think about what would an ideal asset owner look like 20 years from now. Let's start with a blank sheet of paper and say, you have a balance sheet of over, say, $100 billion. It's essentially permanent capital. You are, in one case, we're working with your tax-free in the United States. You have much lower cost of capital than most of your competitors in the public and private markets. If you were starting from scratch right now, how would you build your organization? How would you build your effort to capture all the different sources of return that you need to achieve your long-term investment objective? Oh, and by the way, you need to generate 8% annualized return in perpetuity. Okay? If you were starting from scratch, you would do the kinds of things that Dr. Chang mentioned. You would look at insourcing. You would look at much higher engagement. By the way, that means demanding more from your asset managers and asset servicers and banks for less, right? And integrating the value chain, that means, to me, in many ways, cutting out components of the economics of the chain from your assets to the end investment. Mm-hmm. And that's what we're seeing, and that's how we're engaging most with clients. Now, the implications of this change in relative power from the asset owners versus the asset managers and asset servicers and banks have very profound implications organizationally for the asset owners. Governance implications, human resource implications, risk management implications, technology implications, and any of those topics would be a whole panel. But where I spend my time, where I think is of most interest, is what about on the investment side? So we've talked about insourcing. indexing, lower fees, but it's also about, and I know, Zubair, you'll speak to, the increase in exposure to alternative investments. We think of that as, well, if you can lock up capital, if you have an edge, let's capture the illiquidity premium, let's capture the complexity premium, but why stop there? Let's think about leveraging our balance sheet. Let's think about replacing banks in traditional liquidity provision and other traditional banking activities. Let's think about writing insurance. Let's think about doing all of these things that, because of Dodd-Frank and Basel III and Sarbanes-Oxley, now banks and other players in the markets are exiting, paring back, reducing their balance sheets. And that's, I think, one of the most profound set of changes that we're seeing. And I think things are more interesting when you mention some specifics. So just a couple of examples that we're seeing right now are writing insurance. Insurance has been written by insurance companies at a certain return premium, et cetera, et cetera. Not a great time in the cycle, but what about writing index options? Index options are written primarily by broker-dealers, high cost of capital. There are more buyers of index options than sellers of index options. Why shouldn't every long-term investment program be writing index options? They've got the time horizon to hedge the risk, the tail risk associated with it. It's a very rich premium. That's an example. Another example is taking more of the economics associated with the GPs that you're investing in, whether it's buying a chunk of them, whether it's joint venturing, whether it's partnering, whether it's building capital pools to help them retain risk and gather more of the economics of, say, a collateralized loan obligation business where the asset managers have to retain equity now because of regulatory changes, but they don't have enough capital to do so. If you as an asset owner can partner with your asset managers, can take on a portion of the economics associated with what may also be an attractive return stream, an attractive beta.
Great, thank you, Eric. Stella, I'd like to turn to you now in terms of being another large asset owner within the room, and really explore some of the issues around the challenges around the evolution of long-term investing from the perspective of not just the sovereign wealth fund, but also being based in Africa and an emerging market economy.
Thank you, Han. Before I go into my subject, I just also want to react to comments from fellow panelists. As an asset owner, we are one of those that are concerned about fees. It's become increasingly difficult to justify fees when the returns on the portfolio are optimal, as and sometimes negative. So there has been a real push by stakeholders. Sometimes you get challenges such as it might be better for you to just hold cash instead of investing because the returns are not there, and then the fees for that exacerbate the negative positions that you get. So it's becoming quite a topical subject. We are beginning to look at creative ways to manage this. So some aspects of our portfolio, we are trying to do some of the actions that have been suggested. So looking at ways to basically take out costs by investing by ourselves, removing the cost and keeping some of the economics internally. It's not easy. You have to grow your resources. You have to grow your capability to be able to do that. But that's the general trend that we see. Coming back to the subject of the challenges that we faced as an asset owner investing, I would like to give some context by introducing from the Nigeria Sovereign Investment Authority. So essentially, we started operations in 2012, October 2012. Our source of funding is from the Federation, which is all tiers of government in the country, federal, states, and local government. The funding is meant to come from excess revenues generated from sale of hydrocarbons. Excess over budgetary requirements is what we get to manage. Currently, we have about 1.7 billion in dollars in form of assets under management. Our mandates and key objectives are three-pronged. First of all, we have an economic or fiscal stabilization mandate, We're expected to do that through the establishment of a stabilization fund. This stabilization fund is such that it can be called on, triggered by an instance from the finance minister at any point in time, as may be required. We have a Future Generations Fund. We're meant to be using that to save for future generations of Nigeria. And we also have a mandate to invest in Nigeria infrastructure. And we have to do that through the Nigeria Infrastructure Fund. For the Future Generations Fund and the Infrastructure Fund, they can be called. They're really long-term focus. Outflows are only via dividends, which can only be paid after 5 years of sustainable profits across the three funds. That's the only time dividends can be paid, and drawing from those funds is only through those dividends. So that's the fund that we're managing in a nutshell. When we started operations 2012, 2013, market conditions were were contrasting and presented quite interesting challenges for us. So looking at the local environment, Nigeria had recently come out of the global financial crisis reasonably unscathed, and that was because we had a pot of extra reserves of about 20 billion that was sitting in an excess crude account that the government had and was able to use to mitigate the effects of that financial crisis. The general political environment was relatively stable, macroeconomics fairly stable, at the time, oil price was above $100. Exchange rate was around 150 nairas to the dollar, and the exchange rate regime was quite stable. So, and really attracting a lot of capital inflows into the country. In 2013 and 2014, we had highs of around $21 billion coming into the country each year. So it was very positive outlook. We had great expectations that our best case outlook for the fund was that we would grow to something like 5 billion by 2015. So, it was good, positive. Our local stakeholders had quite interesting expectations of us in the context of the global environment, which at the time was not doing quite well, still struggling with the impacts of the financial crisis. And basically, the traditional asset classes were, yielding very low single-digit kind of returns, sometimes sub 1% in the money markets. So the local expectation was that we will invest we would actually bring the funds that we were given, which were in dollars, into the country, invest in fixed income, invest in the local equity markets, and basically make fantastical returns, and by the way, do that without losing any money. So that was the local expectation. We were faced with the challenges of being able to come up with asset allocation strategies that would deal with the objectives of our three funds, which all of them are quite distinct and have different ways of managing them optimally, and also dealing with the contrasting expectations of our local stakeholders, which was effectively make all the money and, by the way, don't lose any money doing it. So what did we do? We used our asset allocation strategies to try to balance these expectations. So 20% of the funds, which was the minimum allocation possible, was put into the stabilization fund. 40% each directed to the Future Generations Fund and the Infrastructure Fund. In total, what we tried to achieve was to have 60% of the portfolio to be invested globally in international markets. The objective of this was to diversify away from Nigeria and the source of our income. We also took positioning with the currency. We decided to retain the USD as our primary currency as a way of managing foreign exchange shocks on our portfolio. For the stabilization fund, we prioritized capital preservation there and liquidity. The mandate there was basically to invest in investment-grade US fixed income products. For the Future Generations Fund, we did something that was quite unique at the time and considered unusual and atypical for a new sovereign fund that was just emerging. We put 60% of our asset allocation into alternative asset class, so private equity, hedge funds, commodity, real estate, and the like. The idea was to borrow from what global investors were doing. At the time, they were all looking towards emerging markets, looking towards frontier markets, looking at the alternative asset classes for yield. Since we were starting from a clean slate and we had the opportunity, we felt, let's get right in there. We did that significant allocation in the Future Generations Fund. For our infrastructure fund, we focused on 5 core areas: power, healthcare, real estate, agriculture, and motorways, so roads infrastructure. These were sectors that we felt we could impact in most, and also sectors that we felt would have the most impact on the Nigerian economy. And if we fast forward to now, I think things have changed quite significantly. So in Nigeria, our fortunes have somewhat reversed because of again, global trends and some specific country conditions. So all commodity prices have dropped significantly, and we've had a significant impact as a result. For example, I would have to say our currency has become extremely stressed. So the Naira, which was previously exchanging at 150, now exchanging at about 305 Naira to the dollar. So quite a significant devaluation in a 4-year period. Because of the challenges, we've seen a significant drop in foreign capital flows into the country. We previously had a high of about 20 billion per annum. We are now looking at, as at half of 2016, something like 1.8 billion, compared to what was there before. So it's been quite a significant reversal in trends. Global markets have seen significant shocks, from the east to the west. And just to round up, I think what I can say is that the strategies that we had, that we took right at the beginning have kind of helped us to mitigate the shocks that, have been there both locally and internationally. And I'll leave it there. Thank you.
Great. No, thank you, Stella. That's very insightful. Zubed, your role is quite different from the others on the panel right here, but I think it adds an interesting perspective as an advisor to a lot of the organizations on the stage. But I'd like to touch on some of the themes that Stella addressed in terms of asset allocation, and get your thoughts on how you at Citi have seen the evolutions of asset allocation in light of what we're experiencing in this new normal.
Absolutely, thank you, and it's a pleasure to be in Baku, great city, and talk to this group of both asset owners and asset managers as well as service providers. My perspective is really from the perspective of having covered private equity firms over the last 30 years and over the last 10 years, as many of the sovereign wealth funds that are sitting in this room and pension funds started emerging, started covering them from being able to provide primarily a focus on alternative investments in terms of opportunities in direct equity, infrastructure, and real estate. A couple of themes that have come up. I think one of the biggest developments, as Eric touched on, is the changing relationships, the traditional relationships between asset owners, managers, as well as service providers, which is then leading to changes, not just organizationally within the funds, the asset owners themselves, but the organizations as they try to make sure that we provide our best services to the most important needs. The word that we use at our firm is convergence, because what we are seeing is that the kind of the historical lines and distinctions among these groups of investors are changing. Private equity firms, sovereign wealth funds, pension funds, large family offices, traditional asset managers and insurance companies like BlackRock and TIAA-CREF, who are all getting into the alternatives asset class because of the reasons that we have talked about, which is dwindling returns in the traditional public equity and fixed income asset classes. And in order to deal with this, we actually did something about 6 months ago as a firm, which is we combined our global coverage of all of these asset managers into one group. Because what we were finding was that, deals that we were showing to sovereign wealth funds were extremely attractive to family offices because of the orientation of long-term partnerships with management teams, not trying to sell, the companies in the equity markets in a short period of time. Private equity firms not being able to compete with the sovereign wealth funds and pension funds, where a lot of our clients who were looking for long-term capital basically said, we don't want to go to private equity firms because we don't want a gun to our heads to take the company public in 5 years. We want to have an 8 to 10 year horizon in terms of liquidity. So we are seeing a lot of convergence from all sides. Just to touch on a couple of major themes, I think the ultimate challenge for this long-term investing is, even though sovereign wealth funds and pension funds should be best positioned, as Eric was saying, in being able to really look beyond the near-term volatility and the challenges to invest in asset classes as well as opportunities where some of the other owners are reluctant to invest in. At the same time, over the last decade, we have had a lot of transparency among these funds, a lot of information sharing in terms of returns. And at the end of the day, unfortunately, there's always an expectation of what you have done in the short term as well. And that always creates this tension between trying to be smart about taking advantage of long-term opportunities, but at the same time making sure that people don't say, well, you're not producing any returns in the near term either. So ultimately, it's the right balance. So what are the trends that we are seeing? And we have had to adjust our organization significantly in order to be able to provide the right ideas to the team. So the first trend that Eric touched on is there is a general trend, despite the reasons why we are talking about, which is pressure on fees, et cetera, towards internal management, right? I mean, if you look at the percentage of assets being internally versus externally managed, there is a long-term trend towards increasing internal management. That's not just to improve the fee-adjusted returns, but there is an objective by every one of these national organizations to increase the investment talent pool within the countries. I mean, that's a real kind of non-monetary objective that the firms are trying to create. And so there has been a desire to attract talent and be seen as globally smart investors. And many of the funds have been able to get the flexibility of changing their compensation structures, but many are still challenged because ultimately they are public sector organizations and it's not that easy to get those changes. But we have seen a number of the funds who had not been able to do that in the past have dramatically changed the compensation structure, and as such have been able to attract a lot of talent from traditional asset management firms, many with the same nationalities as the residents of the funds, but that's something that we are seeing. And similarly on the investment committees, as people go towards more internal management, we have seen the broadening of the investment committees to bring people from different perspectives to be able to make sure that the risk management aspects of doing more on your own are also managed properly. The second thing, and this is where I want to touch on, is asset allocation. Yes, there is a significant trend towards alternative investments. The challenge there is that some of the traditional expectations of what one can get in terms of returns from those alternative investments has not changed. Somehow people think that those returns are going to be static, even though the returns on fixed income and public equities are going down, despite the fact that there has been a massive amount of capital coming into those asset classes. So today, if you look at the Canadian pension funds who have been kind of taking the lead over the last 8 to 10 years in alternatives, the allocation to alternative ranges anywhere from 30 to 45%. CPP today, Canada Pension Plans, is roughly 45% of their assets are in real estate infrastructure and private or direct equity. Most of the other funds have generally stated a desire to get to 15 to 20% in terms of alternative assets. Now, that is leading to a massive amount of competition for these asset classes. That is changing the traditional GP-LP relationship. So I take the example of infrastructure, for example. Historically, when pension funds and sovereign wealth funds got into that business, they relied on the GPs to do that. Traditionally, for core infra, which is regulated and contracted assets in developed markets, the return expectations used to be in low to mid-teens. But when the Canadian pension funds started going direct and many of the Australian funds started going direct, many of those assets or investments are being sold for sub-10, sub-9% rates of return. So there have been a massive changing of the relationships between the GPs and the LPs there as well. On the real estate side, again, we are seeing significant changes where traditionally everyone was focused on core office properties in prime cities globally. And as the cap rates in New York went from 7% to sub 4%, people said, gee, you know, there's too much risk to be investing in these types of properties on our own. So some of the more experienced LPs or pension funds and sovereign wealth funds started getting into development projects. So Hudson Yards, which is a massive project in New York, a number of pension funds teamed up with developers to come in and provide capital for that. And we are seeing a gradual acceptance of getting into tier 2 cities where you can still find cap rates which are 6, 7%, as opposed to the sub 4% in some of the major markets. Just finishing up, and we can come back to this. One of the other major trends which has changed the way we cover some of the sovereign wealth and pension funds is historically we used to say, whereas private equity firms have expanded globally over time by opening regional offices and then over time raising regional funds, when we started doing this at Citi 6, 7 years ago, we had to deliver global ideas across all asset classes into the headquarters of most of the sovereign wealth and pension funds, right? Because they did not have global offices. But in the last 5 years, certainly the Canadian pension funds have gone from, you know, Toronto and Montreal to London, Sao Paulo, Mexico City, Mumbai, Singapore. But we are seeing similar things from the GICs and Temasek, who have offices in all of these cities now. We have seen Qatar Investment Authority open up an office in New York. We have seen CIC announce an office in New York. And the reason why that is happening is that as more and more of the capital is allocated to alternative investments, the need to find the right partners, whether they are the GP relationships, or in the case of real estate, for example, there are operating partners in many of these major cities. Everyone believes that the way to differentiate is to get closer to your partners, to get closer to the deal sourcing opportunities, because it's very tough to kind of find them from where you are located. So we have seen a significant hiring of resources in each one of these markets and a significant change in how deals are being sourced. Anyway, I'm going to stop there and then cover some of this.
No, that's great, Zubair. I think that's especially the theme of asset allocation will be paramount in terms of determining the future, given how all the large asset owners have strategic asset allocations that are now being revisited in light of the new economic environment. One thing, if I could follow up with you on, the theme of this conference is co-investment. So if you could touch briefly on some co-investment themes on this, as we explore the future of investment management.
Yeah, just quickly. I think the theme is extremely important because we are seeing the co-investments, the partnerships, and I said they come in many different colors. I mean, there's clearly have always been partnerships between the LPs and GPs across private equity and infrastructure and real estate, but now we are seeing an increasing comfort with corporate partnerships in direct equity. Historically, sovereigns and pensions had a tough time thinking about partnering with corporates in terms of different industry sectors to go and actually provide capital for them to grow their businesses. But there has been a gradual acceptance of that and comfort with that because, again, a dearth of opportunities where so much capital is competing for these opportunities. I think, this concept of co-investment, it's already happening. As I mentioned, in infrastructure, it's a given now. We are working on a number of projects. We have been working on a number of projects where all the infrastructure investors, as I said, typically the Canadian pension funds and the Australian funds have taken lead status in these opportunities where they do the bulk of the sourcing, the diligence, the structuring, and then the asset management of the investments themselves. They take the lead, but then there is a group of people who are talking to each other. They have similar interest in terms of long-term objectives and return objectives. And not everyone teams up with the same people in every deal, but there is an ability for all of these consortia to get formed. So that's pretty much become the norm in the infrastructure business. And people call each other and discuss specific deals, and then these consortia get formed. I think on the real estate side, as I said, there was always partnerships with the GPs, but now we have partnerships with major developers in Europe and the US, as well as in the emerging markets. I think that theme is going to be very important in the emerging markets. And the last thing I would say is that one of the biggest things, and the previous panel touched on this as well, is that there is obviously a big gap between where the infrastructure needs are globally, which is greenfield investment in the emerging markets, with where all the capital is focused on, which is brownfield investment in developed markets. And we have been spending a lot of time as a firm taking some of Eric's comments in terms of getting comfort with insurance and how you look at some of the country risks to try to bridge this divide, because there is massive number of opportunities if we can actually get that capital to move into the areas where you have the biggest opportunities. And that's where partnerships, and again, a number of the funds are represented here. I think the whole concept of a sovereign development fund, where I think whether it's the RDIF example, whether it's the ITMAR example, whether it's the infrastructure component of the NSIA example, because as international investors are looking to go into emerging markets, governance, transparency, all of those issues are extremely important. And if institutions like RDIF, NSI, ITMAR have done a great job of attracting talent and setting up the right governance and transparency procedures, they are the partners of choice in those countries for foreign investors to come and co-invest with them in those countries.
Great. Thank you so much, Zubed. Following up on that, I think the idea of emerging markets, and Stella and I had an interesting conversation yesterday where we were talking about where issues like technology, demographics, and inequality will enable defensible profits. And I was wondering if you could address that from the African perspective, as well as being a commodity-based sovereign fund.
Yes, thank you. I'd like to paint a picture for us using Africa as a case study. So in the last decade, Africa has been amongst the fastest growing regions in the world. It's projected to continue to be amongst the fastest growing going into the next decade, in particular over the next 5 years. Let's look at the population. Population growth is also expected to be one of the fastest in the region. The statistics, World Bank statistics indicate that by 2050, more than 50% of the world's population will be African. And if I bring that home to Nigeria, Nigeria is expected to be the third most populous country in the world. By then, we would be at around 440 million. We would have surpassed America. And then think about the composition, the demographics of that population, very young. Currently, there is about 60% that's less than 24 years old. So we have 40% that are below the age of 15 and another 20% between 15 and 24. And the rate of urbanization is also extremely fast. One recent report from the McKinsey Group indicates or estimates that there will be around 24 million Africans relocating to cities every year over the next 25 years. Can you imagine, just imagine that? This will happen whether we like it or not. That said, I think one of the recent trends, the global shocks, which have kind of driven commodity prices down, has created a new trend where we're seeing two groups of countries emerge in Africa. So there's the resource-rich countries which economic growth has been dependent on the resources that they have. So the likes of Nigeria, Angola, Zambia, and South Africa to some extent. And for these countries, they've seen a sharp decline since 2015 in their economic growth because of the commodity-driven shocks. Then you have the non-resource countries who have had to diversify their economies just in order to continue growing, and they have been positioned to be able to take advantage of the low commodity prices. So, these are the kind of trends that we're seeing. The phenomenon that I've just described is extremely exciting, but it's also quite scary on the other hand. But just for the purposes of this discussion, I would like to focus on the exciting part, the opportunities that this presents for us and for the global investing world. So if we think about the young population and growing population, all of these people have to be, the young in particular have to be educated so that they can be productive members of society. All this growing population and workforce need to be fed, they need to be clothed, they need to be housed, they need services, healthcare services, financial services, and the opportunities abound for how these markets can kind of change to be able to take advantage of the assets that they have. Governments have to begin to really be more driven towards putting policies that will enable the kind of growth in the sectors that will enable them to be able to create the kind of environment required for their countries to, really continue growing. These people need jobs, they need cities that work. If we look at the resource-rich countries who are now stressed, there is now an imperative for them to look inwards and begin to restructure their economies quite seriously. They have to push policies, they have to begin to raise resources to invest in sectors that will generate that non-resource revenue stream for them in the future. There's some thinking that some of the sectors that will make quite a big impact are, for example, in the agric and agro-processing sectors. There's manufacturing capabilities, there's industrialization generally, and of course the big push on infrastructure. So in Nigeria, for example, we have had like a 14 billion infrastructure. There's a requirement to actually invest about 14 billion annually to be able to close the infrastructure gap. There's a report that indicates that globally in Africa, we need about $150 billion annually over the next 10 years to be able to build the infrastructure that is required. So the opportunities abound, technology is required to transform and to basically leapfrog in terms of getting the economies there. The opportunities are there, and so definitely defensible profits if we can get it right.
Excellent. Thank you so much, Stella. Following up on the theme of technology, I'd like to shift gears a little bit and talk to Eric about the idea right now with informational efficiencies. We have access with the internet, with just the availability of information is staggering, and that's in effect created shortened horizons for a lot of people. Is there a way what can long-term investors do in this kind of environment?
Yeah, we've definitely seen a shortening of investment time horizons, which should be troubling for any long-term investment managers and asset owners. That particularly as we have a confluence of the traditional providers of liquidity to markets, the investment banks for regulatory reasons reducing the size of their liquidity provision capabilities. So this is troubling. It means that risk management has to play a stronger role at the asset owner level, at the asset manager level, but it also means there's going to be opportunities. Back to becoming a liquidity provider, we will see, it's our expectation that we're going to see more short bursts of volatility, air pockets in markets, like what we saw at the end of last year and early this year in the credit markets, where for another confluence of reasons, U.S. mutual fund blows up to some concerns about Federal Reserve, energy prices. The credit market goes into free fall for 2 or 3 months. If you were sitting there with liquidity as an asset owner and able to be opportunistic and had the governance structure in place such that you could provide a bucket of liquidity at that moment, you could pick up good credit, good paper at 80 or 90 cents on the dollar, buying good paper from distressed sellers. And so you need to have the ability in place, we would suggest, to be able to be in that position, to be that liquidity provider, kind of a reinsurer on the traditional prop desk liquidity provision capabilities. Another potentially troubling but also a potential opportunity associated with this increased short-termism is, and this is a new analysis that we're going through, and I'm not sure we've really internalized all the aspects of this yet, is kind of the diminishment of the public equity markets. In the United States, we've seen the number of listed companies go from about 6,700 in 2000 to now around 3,500. At the same time, the number of private equity-owned companies went from under 1,000 to over 6,700. Now, the cynics among us, and many of you I'm sure are having this thought, may say that just means KKR and Blackstone have too much money, and there may be some of that, but it also reflects this notion that it is more attractive in many ways to be privately owned than publicly owned. And that has both significant opportunity associated with asset owners. It also means that private equity may go from kind of an exotic source of spice and excess return to being a beta you need to participate in to actually own a meaningful swath of the global public markets. And then back to the talk about inequality, there may be another troubling aspect of this. If more and more companies are owned privately and fewer companies are owned publicly, then how does the individual investor, how do the smaller investors gain access to these companies? They can't access them through the public markets, through a mutual fund, through individual equity ownership. Is there an opportunity for large asset owners to package pools of private equity companies and offer that return streams, offer those return streams through defined contribution plans to individual investors. I think we need to continually be thinking and pushing areas of innovation as these trends continue to unfold.
Okay, great. No, I think that those are excellent insights, Eric. I think the call to innovation is extremely important and a huge responsibility for all of us. Sun-Young, let's shift gears again and to a more regional perspective. How is ICD looking to invest for the future of Dubai? Just
For future generation of Dubai, actually, Dubai has been focusing on building two key strategic industries, which will make Dubai attractive destination. One is transportation, which will provide better access to Dubai from outside world. That explains why ICD owns 100% of Emirates Airline, Fly Dubai, Dinata, all that kind of strategy. Second strategic industry is tourism industry. If somebody visits Dubai, he should be able to enjoy, right? He should be entertained. So for this purpose, ICD has a substantial amount of investment in hotel industry, especially over the past 3 years, we invested a lot. But ICD aim to build leading global luxury hotel operator. Number one, as Emirates Airline did in the airline industry, we want to build number one luxury hotel operator, which is compatible with the luxury image of Dubai. For this purpose, 2 years ago, we bought Cosno International. Cosno International owns One and Only and the Atlantis. So you are now expanding these two hotel brands. You'll see One and Only Montenegro soon. You'll see One and Only China in Hainan Island. Also, you'll see Atlantis China next year. It will be complete next year. So, like this now, you are pushing globalization of these two brands, especially One and Only brand. In several years, you can use them around the world. So, for the future generation that we are of Dubai, ICD wanna make it, Dubai as a most attractive, destination. So that's why you are focusing on.
great, thank you so much.
I just wanted to touch on the 2 points that Eric made, just to give you, practical kind of discussions we have had. We have been talking to some of our pension fund sovereign wealth fund clients that it's so important as long-term investors to have this concept of a tactical asset allocation portfolio, which is to do exactly what you were talking about. So just to give you an example on Brexit, and some of them are actually beginning to think along those lines. When Brexit happened, the initial reaction was, oh, we should go and call all of our clients and talk about hedging and whether they want to, protect more of the downside risk. And as we were calling around, one of them said, look, we have been long-term investors in the UK. We have a long-term view on the UK. We know we're going to go through the volatility. In fact, what would be the most helpful to us is show us public and private deals where there has been overselling, and we can go in right now and scoop up those assets, right? And we said, that's fantastic, right? That's how you want to think as long-term investors. The second thing in terms of how organizations are changing, and this is on the private company discussion that you just had, a lot of sovereign wealth funds and pension funds want to be owners of attractive assets over the long term. The liquidity is not that important, especially if you can get some level of dividends along the way. And so, as I mentioned, we worked on a transaction recently for a large global company that needed to sell one of its assets. They wanted to sell 49.9% of the assets to long-term investors because they felt that spinning this division off would allow them to finance it separately from the public company in order to consolidate the industry, and then maybe down the road, 7, 8, 9 years, take it public at a much larger profit and a much better multiple. The mandate was not to go to any private equity firms, as I mentioned, and ultimately 2 pension funds came into the process. Now, what's been happening with the private equity firms is that they are beginning not to be able to have access to these types of deals. So talking about how organizations are changing, so there has been a development in the business over the last 2 years, which is the raising of what we call core funds, which are long-term 14-year investment horizons as opposed to typical 7 to 8-year horizon. These long-term core funds are raising capital from some of the investors who are in this room to basically invest in these companies that can stay private forever and maybe slightly lower returns than typical private equity, but without the need to take them public or to keep them churning around. So we are beginning to see some of these things, and we hope that we continue to see more of these developments because they make sense for the position that these asset owners have.
Great, thanks, Zubed. Unfortunately, we're hitting the end of our time, and I want to be respectful of the next panel. So I just want to wrap up by saying we've heard a lot of very interesting insights from our panelists today. And the question we've been trying to address is, what is the future of investing? What's the future of long-term investing? And my answer to that is the future is all of us sitting in this room right here today. So in the spirit of this conference, I would say the key is keep sharing ideas, keep innovating, and that's how we will be shaping the future of long-term investment management. So with that, I'd like to thank our hosts, the State Oil Fund of Azerbaijan, for inviting us to beautiful Baku. And I'd like to give a hand to our panelists and who are sharing their insights today. Thank you so much. Thank you.